Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Jill Malandrino on the line. She's a product development manager for OptionsProfit at TheStreet. Jill, how you doing on this Tuesday morning?
Doing very well. Lots of news out today, huh?
Oh, yes. Yeah. But before we get to that, could you give us a little bit of your background, your education, and your history in your markets, and how you ended up working for the street and doing the options profit segment?
Sure, of course. So I've been on Wall Street for about 20 years at this point, a little bit unconventional in terms of my background with education. Actually went to community college in New Jersey and then got into an institutional trading desk in the city and finished off school at night at Marymount, Manhattan, and here I am. So the last institutional desk I was on, I was running institutional marketing at Prudential. We shut down the entire division June 2007, decided that the sell side was transitioning, as it has, as we've seen what happened with the financial crisis, and decided to go into media, so have the best of both worlds here, running the Options Profits product, and also contributing now to Action Alerts Options, which is the options overlay to Jim Cramer's charitable trust, Action Alerts Plus. So we have a lot going on here. In addition to working on Action Alerts Options, Mike Kohls, who's also a CNBC Fast Money contributor, is running that platform as well. So a lot of great exposure with him and working on some new ideas and strategies. So it's options all the time here right now.
Do you have a good story that you can share with us from the institutional marketing desk at Pru? Or something, a valuable learning experience you got from that you've used to make your successful career?
You know what? One thing I learned on the marketing end of Prudential, especially when we were putting together marketing packages or working with the analysts, whether it was on launches or upgrades, downgrades, or putting together a special presentation, and I think it's something that correlates to what we're seeing this morning with AOL and Verizon, that content is king, and that's why Verizon is making this purchase, just like we saw in the institutional equity marketing desk, that all headlines that you produce, the content, the way it was differentiated from other sell-side institutions is what set us apart as an independent research firm, and I think that's what you're seeing transition into larger media outlets today, that content and differentiation is always going to be king regardless of whether we're in a more electronic age or not. So I think that's one way you could correlate that experience to what we're seeing even today.
Okay, well, I was going to go into the market there, general market, but you brought up the hot topic of the day here. Verizon buying AOL a lot cheaper price than Time Warner purchased it for. And you mentioned, content is king here. What future implications do you think this deal has in the industry?
Well, what's really interesting is one of our contributors on Real Money at TheStreet brought this up. When Time Warner acquired AOL, it was March 12, 2000, and if you think about it, that was a huge deal at the time, and that's when the market started to top off. So even though market composure is a little bit different. The stress it's under is certainly different than 2000. You have to wonder if the media is going to start to correlate some of these. Could this acquisition be another turning point? And again, obviously, major differences in terms of the valuation and market composure. And I think it's going to be much different this time, but I think it's kind of ironic that we saw the first deal take place just as the market topped out in 2000. But, you really have to hand it to AOL. They returned to growth just as they promised they did when the new CEO came on board in 2009. They grew revenues. I think this deal really is a feather in the cap. And as far as Verizon is concerned, I think it's a great acquisition. They're going to be a tech and content powerhouse, and this really could be the next generation in terms of mobile video and, of course, the ad platform and resources that AOL brings on. So I think this is going to be interesting to see how it's the next phase in tech and content and how Verizon runs with this acquisition.
I'm looking at the pre-market trading here, and it's really tough to come up with actual sympathy plays here. Yahoo, basically, the value of the Yahoo operations is valued at zero.
Right.
All in the Alibaba content here. Do you think, this perks things up? It is trading up in the pre-market. You also have Alibaba trading up. Actually, the Yahoo's trading up more, which certainly doesn't fit with the correlations here. You think this would be something to kickstart Yahoo's had a nice run. It's kind of stalled at 45. You think some people are going to be kicking the tires on Yahoo?
You might obviously people who are long Yahoo hope, so you're always going to get speculation and sympathy of the deals. It happens across every sector, every deal that comes to market. I think Yahoo and AOL, it's almost apples to oranges because AOL took a different direction in terms of growth, obviously a much stronger platform, obviously why Verizon targeted them over a Yahoo. So, you're going to see that bid in sympathy, but I really don't think that you'll see a play similar to that. I really don't. I think Yahoo, from the way I understand the story, they still want to be standalone. There's still some initiatives that they're working on, but I think in terms of Verizon, if they had to pick an AOL or a Yahoo, that AOL was certainly the better choice. But I think you look at AOL and Yahoo, it's apples to oranges, and I really don't think another acquirer will get that kind of deal should they purchase Yahoo like they did with AOL. So again, you're going to get the sympathy plays out there, maybe for a quick day or swing trade for the longs, but I really don't think that you're going to see anything longer term or substantial come out of it.
Okay, let's move on to the general market here. S&P futures, big day on Friday off the unemployment number. Pulled back a little bit yesterday. Fell down with the German bonds today. Recovering back. I mean, you've been in the market for quite some time. You've seen some bubbles. You've seen some monster rallies here. How would you characterize this current market as we are trading near all-time highs?
What's tough with this market is going into the non-farm payroll number on Friday. The internal technicals really were not that healthy. It was the bears are really sort of setting up for more downside action. And of course, the Fed and what global central banks are doing has certainly been driving the market over the past 6 years. So when we saw that slightly less than expected non-farm payroll number came out, naturally the machines kicked on. You're seeing a little bit of that follow through continue. And again, we're trading off of artificial inflation of the market, if you will. So it's very frustrating for traders because now we kind of come back to the action that we saw Monday through Thursday of last week where a lot of the seasonal headwinds have died down. We're coming out of earnings. Sentiment seems to be the most neutral that it's been in years with the exception of what's happening with the Fed and central banks. So you're seeing a lot of range-bound choppy action, and it's interesting because the focus has really been on equities over the past half decade, but what you're seeing now, it's becoming more about asset classes as equities will take a pause to see what bonds are saying or what's happening with the dollar. I feel like it's the most we've been focused on the dollar because of the impact that it's had to commodities across the board. So it's almost like equities are taking a step back, pausing, looking to see what these other major asset classes are doing. So you're seeing some of that range-bound intraday trading, which is a good thing. It's been very difficult for traders where it's been a check mark bounce every day. So some of that intraday action is healthy. They want to see that, but it's very, very tight range. And I think until we get past interest rate hike speculation and something does happen, obviously it's doubtful it's going to be June. Now we're looking at September. Many people think it'll be early 2016, but the markets hate uncertainty. So a lot of traders I speak with, they want the interest rate hike to happen just so we can move on. And at the end of the day, 25 basis points I don't think is really going to make or break that much, but just to get that uncertainty out of the market will be helpful. Even if we take a look at options, the implied moves looking a little bit out. This was the earnings season. They started out relatively low. There was some complacency in the market, and as we saw earnings get into third or fourth week, implied moves were moving a bit higher, which makes sense because earnings, they were okay, but they weren't that great. Earnings were being made, but revenues were not really in line or they were below. So we started to see the uptick in implied vol. And if you look out to third or fourth quarter where the interest rate hike speculation is taking place, you could see it's elevated there as well. So I think once we finally have that take place, then we could potentially return to a more normal fashion of trading, if you will. But I think until then, you're really going to be stuck in a range, whether it's 2120 down to 2150-ish is sort of the range that we've been looking at, and it makes it a little bit difficult to really determine what direction we're going to take for that reason.
Okay, let's move on to some of the restaurant stocks there being out on the East Coast. Are you a fan of Shake Shack?
You know what? It's interesting. What we do each week with Action Alerts Options, each Monday we put out a piece of implied moves on the earnings print and also its historical move has been. It's interesting. Shake Shack does not have options that trade on it, but I still think it's a name you have to watch. It was one of the hottest IPOs of 2015. Since the IPO, the stock has really not looked back. There was, there was a recent sell-off a bit. Could be some profit taking. There really was not much news on it, but I think the fundamental concern is the cost involved to sustain its business model, and that's a common characteristic that you see in these restaurant stocks. If you take a look at the sector overall, again, it's a very young sector. For the names I looked at were Jack in the Box, El Pollo Loco, and those three.
Okay,
And you could see the implied moves are slightly higher than their historical moves. But I think one of the reasons that the sector was so hot is that there really hasn't been anything new out there. You had your 3D printing sector, but that's been out there for 2-3 years at this point. So this has kind of been the new hot thing over the past 6 months, and I think that's why a lot of buzz has been generated. But it's a very, very competitive marketplace for these restaurant stocks. Margins are relatively low. One concern that I have with restaurant stocks, while a concept can be proven regionally while these companies are still private, just because you go public doesn't necessarily validate that the concept is going to work. So I think we certainly need more time on these to see as the marketing strategies evolve and how they transition their menu items and so forth. So again, while Shake Shack doesn't have options on it, we are still taking a look at it because it's really going to impact the sector. I met with the CEO of Bojangles, which is IPO'd on Friday, and the stock was up over 35% on the day. Traders are just really loving these new concepts that are coming to market. And I think that's why you're seeing some of the momentum there.
Have you ate at Shake Shack?
I have not. I like to think of myself as a relatively healthy eater, so I can't comment on the quality, but
okay.
I can't tell you what's happening in the stock.
That's the important thing. Okay.
Mm-hmm.
And then, of course, the dollar has an effect on the restaurants as well. You mentioned you think people are going for the new concepts here, as opposed, the Apollo locals. What do you think of Mickey D's here? The restructuring, boy, a lot of talk about that. Seems like 90 to 100 has been the range here. What's your takes on Mickey D's?
Well, you're always going to have a dividend story in play there, so it's going to be widely held. But I think it's one of those, if you want to correlate it almost to the big conglomerates that we've seen in the industrial space, like a GE, where they just get so big and they're so all over the place, it almost becomes unmanageable. You have multiple menu items across so many different cultures, regions globally that it gets hard to really manage that. It doesn't feel as if there's a consistent culture there. I think there are better ideas. I think I would look to some of the younger names. But I just, I feel like there's better plays out there. If you want to look at the consumer overall, I think in the softs and the hard lines that there's just much better plays if you want to have a play on the consumer. I just don't think a lot of the issues have been figured out. I mean, you do have some private equity in there, which is going to put some of the bid to the stock because there's going to be some shareholder pressure there. But I just think there's other ideas in consumer that you can look at.
Okay, let's near the end of earnings season here. So the retailers are going to be reporting here. So let's just run down a few of the retailers here. And
Sure.
I know Macys actually does have some options on it. Well, good performing stock here. Came off the $44 level. Could you give us your take on Macys?
Yeah, so Macy's, it's the bellwether of the larger retailer space, and I think another thing we have to remember, too, retail sales are coming out on Wednesday as well. So between Wednesday retail earnings and Thursday retail earnings, there's going to be a lot going on in that space. So I just want to remind everyone to pay attention to retail sales as well. But back to Macy's, being the bellwether of the space, it's one of the in addition to that, has one of the more advanced mobile apps in the sector, and they're really doing well in terms of their initiatives with technology. It's expected to slightly beat on earnings, but again, sales growth is a concern, and we've seen that across the board. Last Tuesday, the company announced the first 4 pilot stores that its new off-price business, Macy's Backstage, is going to open in 2015 in Metro New York. So basically, Macy's Backstage is like a Nordstrom off the rack or Saks off Fifth, and basically, prices will range between 20 to 80% off original and comp prices for similar merchandise. So I think that's going to be the new concept. And as they continue to roll out with their technology initiatives, that's really going to make up where foot traffic has dropped off and where, they're struggling a bit with revenue. But again, that is the bellwether. It's another one of those names that's widely held for the dividend. So I think it's one of those names. If you're going to pick one of the bellwethers of the larger retail space, that would be the one that I would look to, particularly as they're putting so much focus on the omni-channel presence with mobile and online.
Okay, another popular stock in the sector we haven't talked about in a while. J.C. Penney here popped over $9, came back to $8. I mean, it's been it's been a decent performer here, but what's the future for J.C. Penney?
Well, it's interesting because out of all the names that I looked at in terms of implied moves, this was about 3.5% higher than its historical move, and it's really not surprising. Management's looking for same-store sales growth of 4%, and the key here is how much ground does JCPenney have to cover coming off their disastrous Ron Johnson era, as brief as it was, and regain that market share. That's a big ship to get right, and it's going to take time for that to correct itself. The current management team, they've made their cost cuts, but again, in a business that's highly competitive and lower margin, JCPenney still needs to work on its high store count, and there's a lot of analysts out there arguing that they might even need to take more aggressive restructuring measures, and that's something that I want to listen to on the conference call to see if they are looking to do costs in other areas and what they may need to do to be a little bit more aggressive. But I do think that as they start to regain market share, as they start to get their core customer back in, the same-store sales growth should gradually improve. But again, this is a one where their implied move is about 3.5% higher than its historical move, and it's going to be a little bit more volatile than I think other names in the group are. But again, in retail and even the less mature restaurant space, because it is revolved all around the consumer, we have seen that the implied moves are slightly higher than what they have been historically. I think there's a lot of unknowns out there until we kind of right this entire complex.
Okay, all right, just two more quick ones for you here in the retail space. Kohls, I mean, all these stores seem the same to me, but what's your outlook for Kohls here, resting near all-time highs? So,
for Kohls, again, this one, I would say next to JCPenney, the implied move was the second highest, about 2% higher than its historical. It's been performing nicely with same-store sales. It's moving a bit higher, and the operations have improved. Barron's had a positive mention on Kohls over the weekend, which always helps. I'm not a big fan of when stocks run too much into the earnings print, but it is always nice to have positive commentary prior to it. And what Barron's is saying, investors like this one. You have an attractive dividend yield of about 2.5%. The company expects to buy back $1 billion of its shares this year, and they're continuing to make share repurchases a priority. I know share repurchases has kind of been revolving around the whole debate of financial engineering, but I think in this case, they are looking to return cash to its shareholders. And, one thing that you have to realize this company, it hasn't been on sale over the past 18 months, right? So it still represents a good value for investors without that speculation in there. So I think this one, longer term, it quietly outperformed. And the last one that we took a look at was Ralph Lauren, about 1.5% higher than its historical move. This is interesting. It's a mature company. It's in the luxury goods space. It's competitive with a Coach, a Michael Kors, Louis Vuitton, Gucci, Marc Jacobs, those sort of names. And one thing that's interesting, the global luxury goods segment is expected to continue to grow as demand rises. And really, that's something that we've seen even when there was some choppiness over the past 5 to 6 years with the financial crisis. That higher end luxury consumer really has, they're willing to pay for quality and the perception of higher end, and that's what we've seen. So one thing I want to caution on Ralph Lauren, it missed analyst estimates in the third quarter, and it cut 2015 revenue forecast back in February. So should the company post another soft quarter, or if they continue to warn further or take guidance down in 2015, it's obviously going to be under some pressure. So, these larger mature companies like a Coach, like a Kors, like a Ralph Lauren, and I love Coach longer term. We spoke about that in length the last time I was on. What they do is they almost create 3 segments for themselves. They have the higher end, they have the department store end, and then they have the outlet end. And they oversaturate the market with their own goods. And that's why Coach made such a big restructuring effort to remove that saturation from the market. I think Kohls is going to have to go through phases of that as well. So that's something I want to pay attention to when Ralph Lauren comments on the conference call, to hear what they think in terms of oversaturating the market, if there's going to be any restructuring, if they're going to dial back on promotional activity. So these are really, the three key things you want to pay attention to when you look at retail earnings, is obviously what they're doing with sales and revenue growth, same-store sales, and their comp figures. That's really important. But you also want to focus on product mix and promotional activity. So because at the end of the day, those three things lend to either better gross and operating margins or they don't. So those are really the three key things I focus on.
Okay, we just got about an hour worth of fundamental information in 20 minutes, Jill. I cannot thank you enough for coming on. Product Development Manager for the Options Profit at TheStreet. What great information, Jill. You do your homework. We really appreciate it. We hope to have you on again soon.
Okay, thank you very much. Look forward to it.